The balance sheet reports the company's resources or assets and how those resources were funded. Some combination of liabilities and shareholders' equity on a particular date, either end of the quarter or end of the year. This is in contrast with the income statement, which reports a company's revenues, expenses, and profitability over a specified period of time. Just to reiterate that point, because I think that it's an important concept as we think about balance sheet versus income statement and the cash flow statement. The balance sheet represents the financial position of a company at a point in time. It is a snapshot as of that exact date. For example, December 31st, 2023. Whereas the income statement and cash flow statement show the financial metrics of a company over a period of time. For example, from January 1st to December 31st, 2023. You can think about the balance sheet like that annual family photo that you take. It captures that snapshot in time. You might notice in one year how there's a new member of the family because your brother Nick got married. Conversely, in a future year, Grandpa Ron may pass away and you have one less family member in the photo. This is akin to a balance sheet increasing and decreasing assets or liabilities. We can see that there's been a change, but we don't really have the detail around why that change has occurred. Although the picture tells you a lot, you don't get the granularity of all the events that occurred during the year. So think of the income statement like a video camera following you from January 1st to December 31st. It's going to capture every event of the year. It would capture things like Nick's wedding day or Grandpa Ron's funeral. This is akin to the income statement showing the revenues, expenses, gains, and losses for a year. Try to remember, income statement equals movie, balance sheet equals picture. On this slide here, we see an example of McDonald's balance sheet. Recall our fundamental equation in accounting, the most important thing that I said to remember from accounting. Assets equals liabilities plus equity. When we add up the numbers for both sides of the equation, we can see that this balance sheet adheres to that fundamental equation, A equals L plus E. A quick item to consider as we think about the balance sheet. Most balance sheet items are reported at their historical cost. By not allowing assets to be overstated, the historical cost principle is an example of conservatism, and governed by this historical cost principle, the balance sheet does not report the true market value of a company, only its resources and funding at their historical cost, or when they were acquired. This is the most obvious when you look at the balance sheet value of shareholders' equity for a public company and compare that value to the market capitalization of the company that you can find on something like Yahoo Finance or Bloomberg. There will usually be a sizable discrepancy in these numbers, with the market cap of a company being substantially greater than the book value of the shareholders' equity shown on the balance sheet.